The global monetary reset has already started, and if you don't move in the next few months, you are going to be one of the people left holding the bag. I'm not saying that to scare you for views. I'm saying it because I've spent my whole life reading balance sheets, watching how money actually moves, and I can tell you the signs I'm seeing right now are the same signs that show up right before every major shift in the FASR system. Governments are drowning in debt, and they can never pay back the normal way. New rules are quietly being written that change who controls your money and how. And a new kind of digital dollar is being built right now by the biggest companies on the planet that most people have never even heard of. This isn't a guess. It's not a theory I made up to sell you something. It's sitting right there in the laws that already got signed and the announcements that already got made. And most people are going to miss it completely because they're too busy watching the stock ticker to notice the plumbing. Underneath, it's changing. By the end of this video, you're going to understand exactly what's happening, why it's happening now, and what you can actually do about it starting today. Now look, what I'm about to walk you through took me hours of digging through legislation, Fed statements, and corporate filings that 99% of financial media either doesn't understand or doesn't want to explain to you. In plain English, this information is worth real money in your pocket. I mean thousands of dollars over the next few years, and I'm giving it to you for free. All I ask is you hit subscribe right now before you keep watching, because I'm going to be breaking down moves like this as they happen, and you don't want to be the guy who finds out 6 months late. So hit that button, then come right back, because it only gets more important from here. Let's talk about why any of this is happening in the first place. Because you can't understand the moves without understanding the problem they're trying to solve. The United States government owes about $37 trillion. Right now, that number is so big it doesn't mean anything to a normal human brain. So let me put it in terms. You can actually feel if you earned $1 every single second and you never stopped, never slept, never took a day off, it would take you over 1,000,000 years to count to that number. That's the debt. Now, here's the part nobody puts in the headlines. Just the interest on that debt, not paying any of it down, just the interest, is over $1 trillion a year. That's close to $3 billion a day going out the door before the government spends a single cent on anything else. Roads, military, schools, none of that. Just interest. And that number keeps climbing every single day because the debt keeps climbing every single day. I've sat across the table from plenty of businesses drowning in debt over the years, and there's always a moment where the math stops being about strategy and starts being about survival. When the interest payment alone gets bigger than what you're actually spending on the thing that makes you money, you don't have a normal problem anymore. You have a structural one, and structural problems don't get solved with small tweaks around the edges. They force big decisions eventually, whether the people in charge want to make them or not. The federal government is standing right at that line right now. And the three options I mentioned aren't theoretical. They're the only real menu on the table. So if you're running a country, and I've run companies with debt problems, you basically have three options. You can cut spending, but good luck getting any politician reelected on a platform of taking things away from people. You can raise taxes, which is about as popular as a root canal, or you do what every government in human history eventually does when the first two options are too painful. You inflate your way out of it. You let the value of the dollar quietly shrink so the debt gets smaller in real terms, even though the number on paper stays the same or even grows. This isn't some wild conspiracy theory. It's exactly what the United States did after World War II. The country came out of that war with debt close to 100% of the whole economy, and instead of paying it off dollar for dollar, they kept interest rates low and let inflation run a little hot for about 2 decades. The debt shrank from over 100% down to the 20s, and nobody had to pass a law saying we are now stealing a little bit from your savings account every year. It just happened quietly in the background while everybody was watching the price of a gallon of milk instead of watching the plumbing. Now, I want you to really sit with that World War II example for a second, because it's not ancient history. It's a blueprint. Nobody in Washington in 1946 stood up and said, we are now going to quietly reduce the value of everybody's savings for the next 20 years. They just kept interest rates artificially low, let prices drift upward year after year, and let time do the heavy lifting. If you had $100 sitting in a savings account that whole stretch, you technically still had $100 at the end of it, but that $100 bought a fraction of what it used to buy. Nobody took anything from your account directly. The number never changed. Only what that number could actually purchase changed. And that's exactly the kind of tax that never has to go through a vote in Congress. It just happens while everybody's attention is somewhere else, which, by the way, is exactly where most people's attention is right now. That's move number one, and it's happening right now in plain sight. You probably heard the new Fed chair go on television and promise that inflation is coming back down to 2%. Nice and calm, nothing to see here. But here's the thing that should make you sit up. The Fed's own internal forecasts, their numbers, not mine, have inflation running well above that target, and the actual cost of living for regular families is running hotter still. That's not an accident, and it's not incompetence. When inflation runs hotter than the interest rate on government debt, the real cost of that debt shrinks every single year, and the people who pay for that shrinkage are you and me, through higher prices at the grocery store, higher rent, higher everything. It's a tax that never gets a vote in Congress, and it never shows up on your paycheck stub, but you feel it every time you fill up your car or buy groceries for your family. Now let's get into move number two. And this is the one that almost nobody is talking about, but it might be the most important piece of the whole puzzle. Last year, the government signed a law that set up rules for something called stable coins. If you're not familiar, a stable coin is basically a digital dollar. You put in a real dollar, you get a digital token worth $1, and you can trade it, send it, use it just like cash, except it lives on the internet instead of in your wallet. Sounds simple enough, right? Here's the part that matters. That law requires every company that issues one of these digital dollars to back it up with real United States government debt, not gold, not cash sitting in a vault, government debt specifically. So think about what that actually means. Washington just created a brand new legally required category of buyer for its own debt. Every time somebody buys one of these digital dollars, the company behind it has to go out and buy government bonds with that money. That's not a side effect. That is the entire design, and the scale of this thing is only getting started. The largest stablecoin company out there already holds well over $100 billion in government debt, which makes a single crypto company one of the biggest holders of American government debt on planet Earth, bigger than most entire countries. And it's projected to keep growing into the trillions over the next few years. On top of that, just recently, well over 100 major companies, and I'm talking about names like Visa, MasterCard, big banks, big tech companies, all the serious players announced they're building a joint digital dollar together. When you get that many heavy hitters in a room agreeing on one project, that's not a trend. That's an entire new financial rail being built right under your feet. Think about how fast this thing has grown already. A few years ago, stablecoins were a niche product mostly used by crypto traders moving money between exchanges. Now you've got some of the largest financial and technology companies in the world. The kind of companies that touch a huge chunk of every transaction in the country, building this infrastructure together. And when companies that size, companies that normally compete against each other in every other part of their business, come together on one joint project, that tells you the incentive underneath it is enormous. And the incentive here is simple. Whoever issues these digital dollars gets to take your money, park it in government debt, collect the interest on it, and keep every dime of that interest for themselves, because the law specifically bans them from sharing any of that interest with you. The person actually holding the token, you get the convenience of a digital dollar, they get a permanent, growing stream of essentially risk-free income sitting on top of your money. That's the actual business model. And it's a good one, just maybe not for you. Here's why this matters to your money specifically. When there's more demand for government debt, the government can borrow more cheaply and it can borrow more of it because there's always a buyer lined up. That sounds boring, but it's the difference between a government that has to be careful with its spending and a government that has a built-in customer for whatever debt it wants to issue. It's like if you personally had a rich uncle who would buy every single credit card statement you ever ran up, no questions asked, would you spend more carefully? Or would you spend a little looser, knowing somebody's always going to cover it? That's the incentive being built into the system right now. And it's happening with almost zero public conversation about it. Now let's connect that to move number 3, because this is where it all comes together. Every politician, every Treasury Secretary, they all say the same thing. We believe in a strong dollar. It's like saying you believe in apple pie. Nobody's going to argue with you, and it doesn't actually mean anything specific. But there's a school of thought floating around Washington economic circles right now that argues the dollar is actually overvalued and that a controlled gradual decline in its value would help fix trade imbalances and bring manufacturing jobs back home. Now, I don't think any administration is going to stand up at a podium and announce we are devaluing the dollar. In those exact words, that would spook markets overnight, but you don't have to announce it if you can get the same result through the back door. Promise low inflation while actual inflation runs hot. Build a captive buyer base for your debt, so borrowing stays cheap no matter how much you issue. And let the currency quietly lose purchasing power over years, not overnight, so nobody panics all at once. Put those 3 moves together and you get a slow, steady decline in what your dollar's actually worth, dressed up the whole time in calm, reassuring language about stability. And here's the piece that ties it all together into one clean picture. The debt problem creates the pressure. The stablecoin law creates a permanent, built-in buyer for that debt, which keeps borrowing costs low no matter how large the debt grows. And the slow, managed decline in the dollar's value is what actually pays the bill in the end. Spread out quietly over years so nobody feels any single gut punch. They just feel a slow, steady squeeze that's easy to blame on grocery stores or gas stations or the economy instead of the actual source. Individually, each of these 3 things sounds like a reasonable, boring policy decision. Put them together and you're looking at a coordinated system, whether anybody planned it that way on a whiteboard or it just evolved that way out of necessity, that quietly transfers value away from people holding cash and fixed income and toward people holding real productive assets. I want to be really clear about something here, because I don't want you walking away from this thinking it's some evil master plan cooked up by one political party. It's not. Every party that's held power has run some version of this playbook, because frankly, it's the only realistic option available to any government sitting on this much debt. Getting angry about it on social media isn't going to change a single thing. What will change something is understanding it well enough to position your own money on the right side of it. So let's talk about what you actually do with all of this, because information without action is just entertainment, and I don't want to waste your time. First thing, stop sitting on a giant pile of cash beyond what you actually need for emergencies. I'm not telling you to empty your checking account. You absolutely need 3 to 6 months of expenses set aside for real-life emergencies. That's just smart. But anything beyond that, sitting in a savings account earning next to nothing, while prices climb 4, 5, 6% a year. That cash is quietly losing value every single day you hold it. Think of it like an ice cube sitting on the kitchen counter. It looks fine for a while, but the warmer the room gets, the faster it disappears. And you don't even notice until it's basically gone. Look, I get why sitting in cash feels safe. It's simple. It's not going to crash 40% overnight. And you can see the number in your account, and it never seems to go down. That feeling of safety is exactly the trap. The number doesn't go down. But what that number can buy you keeps quietly shrinking every single year. Inflation runs hotter than what your bank pays you in interest. You don't feel it happen in any one moment. You feel it 2 or 3 years later when you realize the same amount of money buys noticeably less than it used to. That's the whole trick. It's designed to be gradual enough that nobody panics and pulls their money out all at once. Second thing, own assets that tend to hold or grow their value when a currency weakens. Real estate is one of the classic examples. Quality real estate in the right locations tends to keep pace with or beat inflation over time. Gold is another one people have used for literally thousands of years for exactly this reason. When currencies get shaky, gold tends to hold its ground. And then there's the stock market, but not just any stocks. You want companies with what I call real pricing power, meaning they can raise their prices when their own costs go up without losing their customers. Think about a company that sells something people genuinely need or are a little addicted to. When costs went up a few years back, a lot of those companies just raised prices. And you know what happened? People kept buying anyway. That's pricing power. And it's basically inflation insurance built right into the business model. And third thing, and this is the one that takes a little more thinking, position yourself near the flow of money instead of standing off to the side watching it happen to you. When you've got trillions of dollars flowing into new digital payment systems, new stablecoin infrastructure, new financial rails being built, somebody is profiting from every single dollar that flows through that pipe. It's the same idea as a gold rush. Sure, some people struck it rich digging for gold, but the people who reliably made money were the ones selling picks and shovels to every single miner walking into town. Financial infrastructure companies, payment processors, custody providers, the businesses that sit in the middle of all this new money movement, those are worth understanding and paying attention to, because that's exactly where the money is going to keep flowing, whether the dollar goes up or down. One more thing on the pricing power idea, because I think it's the part people skip past too fast. When you're looking at a company, ask yourself a simple question. If this company raised its prices 10% tomorrow, would you still buy it? If the answer is yes, because you actually need what they sell or you're genuinely loyal to it, that company has real pricing power. And pricing power is basically a built-in shield against inflation. If the answer is no, because you'd immediately switch to a cheaper competitor, that company doesn't have pricing power. And inflation is going to squeeze their profits instead of protecting them. You don't need a finance degree to figure out which businesses around you fall into which category. You just need to actually think about it instead of buying whatever's trending that week. I'll tell you something I learned a long time ago, building businesses. The people who make money during major shifts are never the ones who panic and dump everything. And they're never the ones who freeze up and do nothing either. They're the ones who take the time to actually understand what's changing, and then they make calm, deliberate moves based on that understanding. Everybody else is out there either selling in a panic at the worst possible moment or sitting frozen doing nothing while the whole thing happens around them. You don't have to be either of those people. You just have to actually pay attention, which, if you've made it this far in the video, you clearly already are. So here's my challenge to you. I want you to go look at your own finances this week, not next month, and this week, and ask yourself honestly, how much of your money is just sitting in cash beyond what you actually need for emergencies? Be honest with yourself about it. And then I want you to think seriously about whether your investments are set up to hold their value. If this slow, quiet devaluation keeps playing out the way it has for the entire history of heavily indebted governments, this isn't about fear and it's not about panic. It's about being one of the people who saw it coming and did something about it instead of one of the people who got caught flat-footed and spent the next decade wondering what and happened to their savings. I built everything I have by paying attention when other people weren't and moving while other people were still arguing about whether something was real or not. This is one of those moments. It's not flashy. It's not going to trend on social media for more than a day, but it is going to quietly determine who comes out ahead over the next 10 or 20 years and who doesn't. Drop a comment down below telling me one move you're going to make this week based on what you just learned. I read every single one of them. And if this video actually opened your eyes to something you hadn't connected before, do me a favor and share it with somebody you care about. because the people who understand this early are always going to be better off than the people who find out last. I'll see you in the next one.